In this video, I'm going to take a look at something called mean reversion using overbought and oversold indicators. This is kind of a general topic, but mean reversion, as most of you will know, is just simply going back to where things typically are. So in trading, a lot of times that means a moving average or an average amount of movement for that particular day, something like that. So in front of you, I have the euro dollar daily chart, and you can see I have stochastic indicators. Now, in this particular indicator, and there's the multitude of indicators out there that you can use. They all work a little bit differently, but essentially a lot of them, which are oscillators, will tell you overbought, which is where we're at now, and oversold. So in this particular case, it looks like we are a little bit overbought. We're trying to cross over and go lower. So that gives you an idea that we're probably going to head back to the mean, which somewhere in this area right here, based upon it being in the middle of this. It's not a massively precise science, but it does give you an idea of when perhaps maybe we are a little overdone in one direction or the other. But there are other indicators that you can use, such as Bollinger Bands. I'll go ahead and put these on here. And this is a moving average in the middle. And the idea is that over time, in this particular case, I believe, yeah, it's 20 is the standard, 20 days in this case. This is roughly the average price of the market, and it's two standard deviations away that you have the bands. And you can see that every time we break out of the bands, we tend to come back to the mean. So recently we have broken out of the bands. Looks like we're going to try to come back to the mean. And that is just simply a signal that we're overbought. Down here, we're oversold, overbought, oversold, etc., etc. And that's really all it is. It comes down to playing the averages. It's not 100% effective, nothing ever is, but it is playing the odds. And the odds are that you're going to fall in that normal range. Now, having said that, it's likely that marketplaces will follow those, but not always. There are black swan events, financial crisis, earthquakes, that kind of thing, military attacks. So it doesn't always work, doesn't work 100% of the time. But over the longer term, the idea is that markets tend to follow the median price and tend to revert to that mean, and therefore you will have many more wins than you will have losses. And at the end of the day, that's the only job you have.